Even though the paychecks stop in retirement, your bills and expenses obviously do not for the most part. And while a lot of people get caught up on the exact dollar amount that they'll need saved before they can retire, I would argue that it's just as important, if not more important, to accurately plan around your major expenses to avoid surprises in retirement. In this video, I'll be teaching you how to prepare for the 3 largest expenses that most retirees face, and even some ways that you can reduce them. Hey everybody, my name is Jake Skellhorn. I'm a certified financial planner and the co-founder of Spark Wealth Advisors. My channel and my firm are both dedicated to giving you more confidence and clarity with your money. Be sure to leave a comment below with any questions and subscribe to the channel for future videos if you enjoy this one. So the first major expense, and probably the biggest expense for most people watching this, is going to be taxes. Obviously, this should come as no surprise. It's probably everyone's largest expense over their lifetime, whether it be income taxes, capital gains taxes, property taxes, or sales taxes. Taxes will always be a part of our life. However, when you retire, it's important to be educated on what you'll pay taxes on, whether it be withdrawals from certain accounts, Social Security, how that might be taxed, etc. And when you retire, you generally have more control over where your taxable income comes from, rather than being employed where you pay ordinary income taxes on every paycheck. So ideally, by the time you've retired, you've built up 3 different tax buckets to pull from for your income. The first one would be tax deferred, and is probably the most common. That would be your 401ks and traditional IRAs, where you previously took a tax deduction to contribute to the account, but when you withdraw it, it's taxed as ordinary income. The next bucket would be your taxable bucket, which would be any individual or joint brokerage accounts, savings that you have at the bank. That just means the interest and dividends or capital gains in these accounts is taxable as you go. The third bucket would be your tax-free bucket, which consists of Roth IRAs and HSA accounts. So ideally, by the time you've retired, you'll have a choice of where you can pull money from and in what order and what amounts. I have made a separate video on this topic specifically. Be sure to check that out at the end of this video. But the gist of that video is, by controlling where you pull your income from, in what order and in what combination, you have a lot of control over what your total income tax liability will be over your lifetime. Another way that you can prepare and possibly limit your tax liability in retirement is by understanding how Social Security benefits are taxed. Depending on your provisional income, up to 85% of your Social Security benefit can be included in your taxable income. So it's important to understand these thresholds and plan ahead accordingly to try to limit that provisional income as well. Ways that you can do this would be to do Roth conversions in the early years of your retirement before you take Social Security. And Roth conversions in general are another way that you can limit your tax liability. And with Roth conversions, you're essentially paying some taxes today instead of paying a lot of taxes later. So there is a trade-off, and there's always a little bit of guessing to it because we don't know for sure what taxes will do in the future. But we can make pretty reasonable assumptions about your future income based on withdrawals, required minimum distributions, and things of that nature. Before we move on to the next major expense in retirement, the last thing that comes to mind when I talk about reducing your tax liability in retirement is through what's called tax gain harvesting. You may be familiar with tax loss harvesting, which is selling investments at a loss so that you can offset gains of other investments or ordinary income. But tax gain harvesting is purposely selling investments that have a long-term capital gain in those brokerage accounts if you're within the 0% long-term capital gains bracket. The idea with tax gain harvesting is similar to that of Roth conversions. You're basically locking in a tax rate today so that you don't have to pay it later on. In this case, that tax rate is 0%. So with tax gain harvesting, you would simply sell enough of your investments to stay within that 0% capital gains bracket, repurchase those same investments, and then later on that reduces what your gains will be when you actually have to sell those investments for income. It's important to note that both Roth conversions and tax gain harvesting can have other effects on your modified adjusted gross income, such as premium tax credits for ACA subsidies and Social Security benefits as well. The next major expense in retirement and how we're going to plan for it is healthcare costs. So this might not come as a surprise to some and a surprise to others, depending on your age and what you expect to get out of Medicare, but healthcare costs can be a significant burden for some in retirement. A recent Fidelity study found that a 65-year-old retiree can expect to spend an average of $165,000 on healthcare costs throughout retirement, and that is in addition to what Medicare covers. It's a common misconception that Medicare will cover all of your healthcare costs in retirement, but that is simply just not the case, unfortunately. In fact, you'll pay a minimum of $174.70 per month for Medicare. That comes directly out of your Social Security benefit if you receive one. For those that will have a relatively high income even in retirement, you also need to look out for IRMA surcharges, which stands for Income Related Monthly Adjustment Amount. And these are essentially additional premiums that you pay for having high income that could be as high as $500 per month. Keep in mind, IRMA surcharges are based off your modified adjusted gross income from 2 years before. In other words, your 2022 income will determine what you pay for Medicare in 2024. This can be an issue for those who have large RMDs due to having large pre-tax balances in your IRAs and 401ks. So a way that Roth conversions can also help here is by reducing not only your income taxes, but your IRMA surcharges if done correctly. Another way to plan ahead or limit your out-of-pocket healthcare costs is to get a Medigap or Medicare Advantage policy to cover what Medicare does not. Health savings accounts are also a great way to save on a tax advantage basis for out-of-pocket healthcare expenses in retirement. Contributions to HSAs are tax deductible, investment earnings inside the account are tax-free, and distributions for qualified medical expenses at any age are also tax-free. In addition to that, you can also withdraw money from an HSA after age 65 for any reason. You'll just pay ordinary income tax, but no penalties. The last thing to mention about this major expense in retirement that is healthcare is long-term care. It's estimated that anywhere between 50 and 70% of folks over age 65 today will need some sort of long-term care in their lives, and long-term care is not cheap. According to a Genworth cost of care study in 2023, the median cost of a private room in a nursing home is over $108,000. This is only going to increase as well if you're still decades away from retirement. So there's a few ways that you can plan ahead for the large expense that is long-term care. Number one being a long-term care insurance policy. We'll want to be careful with long-term care policies because they can be very expensive and the premiums can increase. So definitely make sure you're meeting with a qualified professional and potentially even multiple to get multiple quotes. The second option that most people use is a reverse mortgage. That's basically taking the home equity out of your house to pay for long-term care, as long as you don't have any plans to leave it to a family member or any other goals for your legacy. And the third option is to just self-insure or pay for that out of pocket by setting aside money in your retirement portfolio to pay for long-term care out of your investments when it gets to that point. The third biggest expense in retirement that most people face is housing costs. Even if you have your home paid off, the cost of home maintenance will still persist in retirement, and this can be especially expensive for older homes, which is typically the case if you have already paid it off. So it's important to properly plan for everything from property taxes and insurance to home maintenance and things that only need replaced every few years, such as AC units and roofs. Otherwise, you can potentially derail your retirement plan or have to cut back on your normal spending. For those that simply can't afford to retire with a mortgage, you can consider the option of downsizing or moving to another location that's lower cost. I have talked to plenty of people online who plan to even move to another country because the cost of living is much lower. So these are a few common ways that people are dealing with expensive housing costs in retirement as well. One thing I will say about that, if you're planning to move to another state in the US simply because it doesn't have a state income tax, make sure that you look up things like the sales tax and property taxes in the area. Texas is one example where they don't have a state income tax, but they have a pretty high property tax. So make sure you're considering the full tax picture if you're considering downsizing or moving to another location because you think you'll be saving money on something like state income tax. That's only one piece of the puzzle. I've also talked to plenty of retirees who plan to rent in their retirement. You don't necessarily need to own your home, especially if you do want to relocate or travel. There's nothing wrong with renting, especially when something goes wrong as well with the home that you're in. You don't have to pay for maintenance. You may need renter's insurance, but renting is definitely a viable option for a lot of people in retirement to save money. So while none of these expenses should come as a surprise to anyone, they're probably all expenses that you're paying now. I hope this gave you some ideas on how to plan, prepare, and possibly even reduce some of these major expenses in retirement so that you can live a more stress-free one and a more successful one. If you can think of any other major expenses in retirement that are worth talking about, make sure you leave a comment below to start a conversation with others that might be watching this video. And finally, here's that video regarding a tax-efficient withdrawal sequence from your various retirement accounts that I mentioned in the beginning of this video. Thanks for watching. Be sure to subscribe to the channel, and we'll see you in the next video.